Chapter 12 covers a concept known as accruals and deferrals. In Chapter 12, we're going to focus on what is known as the accrual basis of accounting. The focus is on when do you recognize your revenue transactions and when to record your expense transaction. Under the accrual basis, you recognize revenue when the revenue has been earned, not based upon when cash is received. So you ask yourself, how does a person earn revenue? You can earn revenue from the actual sale of a product. So record revenue when the sales is complete. Or you can earn revenue from the performance of an actual service. So under the accrual basis, we recognize revenue upon completion of the earning process. Again, you're asking yourself, has the sales transaction been completed? Or have we finished providing the actual services? If the answer is yes, under the accrual basis, you recognize revenue at that point in time. So for a sale made on account, meaning cash has not been received yet, we're still going to recognize revenue immediately because the earning process has been completed. Again, it's not contingent upon when cash is received, but it's based upon the completion of what's known as the earning process. When it comes to your expenses, on the accrual basis of accounting, you recognize your expenses as they incur or once an item has been used. It's not contingent upon when cash is paid. So for example, if we're looking at the amount of supplies that have been used during the accounting period, whether we pay for the supplies or not, we're going to recognize supplies expense. So you ask yourself, what expenses took place in order to help earn revenue for the business, even if cash has not been paid at that time? So any expenses that have incurred in order to earn revenue should be recorded in the same accounting principle. We're trying to match revenues and expenses in the same accounting period. So we're saying any expenses that have incurred in order to earn revenue should be recognized in the same accounting period. Now, with the accrual basis of accounting, we have to make what's known as adjusting entries at the end of the accounting period. We want to make sure that all revenue earned has now been recorded. All expenses incurred have been recognized as well. We're going to look at some different type of adjusting entries that a company will make at the end of the accounting period. You ready? Let's go. So for our first type of adjustment, we focus on the merchandise inventory account. You may ask yourself, what is merchandise inventory? It refers to items that we have purchased or produced with the intent to be sold to our customers during the course of the accounting period. Merchandise inventory represents an asset account. Let's say that we have Whiteside Antiques had beginning inventory $52,000. Then at the end of the year, they did a physical count of inventory, and now they have inventory worth $47,000. We need to adjust the inventory count to reflect the balance at the end of the year. To make the adjustment, it is a two-step process. First, we'll look at the merchandise inventory account, and we're going to use the income summary account in order to adjust the merchandise inventory account. So what do? First step, we have to remove from the account the beginning inventory balance. And again, that amount was $52,000. So as of right now, $52,000 is shown on the debit side of the merchandise inventory account. In order to remove the account balance, we're going to credit the account for the $52,000. But of course, if we credit one account, there must be an offset debit, and we're going to debit income summary for $52,000. So the first step is to remove from the inventory account the beginning inventory balance. That's done by debiting income summary and by crediting the merchandise inventory account. In the next step, or step 2, we're going to add to the account the current ending balance, which is for $47,000. So to do that, we're now going to debit the inventory account for the $47,000, credit the income summary account, $47,000. So now the inventory account reflects its current ending balance at the end of the accounting period. So I hear you asking the question, what about the income summary account? Well, this account is temporary and it is going to be closed out during the closing entry process. Our focus right now is to make sure that the inventory account is showing its correct ending balance. Let's look at some other type of adjustments we'll have to make at the end of the accounting period, what we call accrued expense adjustments, as well as prepaid expense adjustments. Think about companies that provide services or sell products on account, meaning that they sell these products or services now and will be paid later. There's always a chance that when you sell products or services on account, that you're not going to receive the amount of money that's owed to you from all of your customers. So under the accrual accounting system, we recognize an expense for those accounts that we expect to become uncollectible. The expense is going to be estimated because the actual amount is not known until later periods. So what we're saying here, we're saying if I look at all of our sales, say for 2019, we're going to ask ourselves, what portion of those sales do we expect are going to become uncollectible? And once we have that amount, we're going to debit a new account title known as uncollectible accounts expense. Now again, this amount is just an estimation. We're going to estimate the expense based upon historical information. So we're asking ourselves, what portion of our credit sales in the past became uncollectible? Was it 1%, 5%, 10%? But based upon historical information, we can estimate what's known as our uncollectible accounts expense. So we have a method called the percentage of net credit sales method. The percentage of net credit sales method. With this approach, we're going to look at our credit sales that took place during the accounting period, and we're going to estimate what percent of those credit sales do we expect to become uncollectible. Perhaps you're saying, how do we estimate this expense? It is based again on historical information for a company. So again, we'll look at historical information to see in the past what percent of a company's credit sales became uncollectible. One example, all right? We're saying that Whiteside Antiques, they estimate that 0.8% of their net credit sales will become uncollectible. For the year, they had net credit sales in the amount of $100,000. To estimate the expense, they'll multiply their net credit sales times their percentage, 0.8%. Now, 0.8% is 0.008 as a decimal. So you multiply your credit sales times the percentage, it would give us $800. This means that for this year, we're going to estimate that $800 of our net credit sales are going to become uncollectible. So we now have to make an adjusting entry, a journal entry. We have another new account title called the allowance for doubtful accounts. This account is a contra asset account. The word contra means opposite or against. This account is used to show that portion of our account receivable that we expect to become uncollectible. So notice that this account has a beginning balance of $250 because this is a permanent account. Permanent account means that the balance from the previous accounting period is carried forward to the upcoming accounting period. So you would debit the expense account for the $800, credit the allowance account for the $800. Now again, this is a contra asset account that appears on the asset section of the balance sheet. So the balance sheet will show the account receivable ending balance. Let's say it may be $32,000, and that's going to be less the allowance for doubtful account for the $1,050. That would give us net account receivable in the amount of $30,950. Okay, we're going to stop this video here and come back with a second video presentation with some other adjustments beginning with depreciation.